Thanks, Madam President, for having me here, and it's nice to be back in Ottawa. It's been a while since I was here. Actually, I think the last time I was here may have been with Charles. We worked at the same venture capital firm for a number of years together, and I was fortunate to make a couple of investments in tech startups in Ottawa in the early part of the decade, the first decade of 2000. And it's always struck me that the entrepreneurial spirit is great around this area, and having spent most of my career now in Boston, I think there's kind of a shared mission, past few years perhaps a bit of shared misery, in that both areas have been hit pretty hard by the telecom flu and the downturn of the economy, where from an entrepreneurship standpoint, there was a large focus on similar projects. But the thing that's remarkable, and you'll see this is I'm trying to be quite optimistic in the presentation I'm going to give you, is despite what's been a rocky road the past few years, I remain incredibly optimistic, possibly more optimistic than I've been since I've been an entrepreneur and a venture capitalist about the opportunities going forward. I'm trying not to whistle past the graveyard around this, and so I think that as I take you through some thoughts, I'm going to try and be brief to make sure we can get to Charles' points, and then also so we can have some time for questions. I think that there are some really big ideas out there. You know, the macro perspective right now is that there is a lingering overhang from the scary times and the uncertainty. But as I mentioned in my opening remarks, there is great opportunity, and we're seeing it spring up kind of from, quite frankly, from the ashes and the difficulties that we've all gone through. And as a continent, I think that North America, and particularly the research universities, are a wellspring of the ideas and are going to see a lot of these innovations that are going to carry us forward. A little bit quickly of my background. As the President mentioned, I have a bachelor's degree from University of Vermont. I started my first business while I was in college there, selling newspapers and magazine subscriptions, and actually bringing that, making it computerized at the time, which was the core innovation. I went to Bell Laboratories, the Nortel of the South afterward, and spent about 3 years there, and then left to join my first real tech startup. And it was a networking communications company that grew. It was kind of the prototypical startup, which you'd love to see. And we grew it from 0 to 300 million in revenue in 6.5 years. Grew from a very small team to a very large team and took the company public. And eventually, it was acquired. I left and went back to business school because I wanted to start companies on my own. Started one while I was in school and raised some angel financing. And then, quite accidentally, started interviewing with a few venture capital firms, and took a job with Greylock, where Charles and I worked together for a number of years, with the intention of staying for a year to find another great startup or a great startup idea to go to. It took me 10 years. It turned out that that great startup idea was another venture capital firm. And then along with one of Charles and my former partners, another guy who worked with us at Greylock, a CEO that we had backed, and another friend of ours, we started our own firm called Flybridge about 7 years ago. So I think these are glory days for technology, and we've made unprecedented advances over the last decade. It's not simply the YouTube generation or the Facebook generation, but when you look at the completion of the human genome mapping, when you look at the advances in consumer technology and the revolutions that have gone on, think about the amount of computing power we all carry personally today, and versus how many rooms that would have filled years before just to have that kind of computing power. The advances are really just tremendous, and I think that this is going to continue on. I think that we're really just seeing the platform for the next 10 years. The conventional wisdom says that we're still in the midst of and clouded by this economic crisis, and you've seen your neighbors to the south in deep trouble from the housing crisis. We see what's going on right now in Europe, and certainly those types of vacillations are going to continue. But it turns out, and this to give fair credit to my friend Brooks Zuttig at HarborVest, he's chronicled what's happened around the venture capital industry over decades, and we've seen this movie before. And it turns out the upshot of this diagram is that the best time to start companies and the best time to invest in companies is as it's bottoming and through the trough. And for all we can tell, we're in the midst of that right now. This is where the best innovations, and another part of this presentation points out the great companies, the world-class technology companies that have been started during these periods. But it includes companies like Microsoft and Apple and others. From a venture capital perspective, our industry has been going through a shakeout as well, and it's long overdue. And we need to adapt the way that entrepreneurs need to adapt, or we won't continue to survive. Sorry, let me go back here. So a very quick prescription for what I think is going to happen. The number of venture capital firms is shrinking. We lost about 15 to 20% really over the past year and a half to 2 years. And there's a prediction that that's going to continue. Personally, I think that our expectation is that half the firms that were in business at the beginning of the century will be out of business before the next 5 years. And ultimately, I think that's actually a good thing. It means that the amount of money flowing into the system will decrease. This is not going to happen overnight because venture capital partnerships are very long-lived. And it does have a trickle-down impact on startups. But fundamentally, the venture capital business is a pretty simple equation. It's an oversupply of great ideas meets an undersupply of capital, and therefore only the best ideas get funded. And if you think about what's gone on in the past decade, it's been the other way around. Actually, it's been, quite frankly, every idea, and you're seeing multiple ideas of the same ilk get funded. The liquidity dries up because customers can wait to see which idea is going to be the one that survives before they have to choose. And I think that this, my industry shrinking will actually be better for the entrepreneurs in this audience. There are positive signs in terms of confidence worldwide. And entrepreneurial interest and passion are growing stronger than ever. So, these are indications that we're starting to see, a real focus on startups kind of emerging. And in some cases, it's out of necessity. When there are no more jobs in big companies and the notion of lifelong employment at companies like Nortel or AT&T or Lucent no longer exist, I think necessity breeds invention. We're seeing, and this maybe leads into talking about the university's role, we're seeing universities really come around and en masse in terms of driving innovation and driving new businesses. I did a count of we've invested in about 50 companies since we started Flybridge, and probably a quarter of them have come from universities in terms of university research. And another quarter of them have come from professors or university researchers their second time around. So really half of what we're funding is coming from great research universities. And they're not just the usual suspects. I'd mentioned to a couple of folks here that we've driven a university research symposium the last 3 years to try and bring together great research, academic research in universities from around North America that aren't, quite frankly, just the places where venture capitalists have been trotting for the past few decades of MIT and Harvard and Stanford and Caltech. We're finding if we look at those companies that we funded that are from universities, probably a quarter of the ones we funded have come from non-traditional, if you think about those mentioned as being traditional universities, and we're finding great, great innovations. We're also seeing a rise of incubators, and not the incubators that were really prevalent at the beginning of the internet bubble, which were really just great real estate plays. We're seeing tremendous innovation around companies that are getting started on a few $100,000 and driving new products. And these products are not just websites or mobile apps or iPhone apps. We're seeing fundamental research in nanotechnology, in semiconductor technology, where entrepreneurs are finding that on short money, really on a few $100,000, they can get past some sort of scientific breakthrough that would then allow them to raise the kind of money to actually grow the business. And that's something that's really kind of an innovation in our business. There are still huge opportunities as we look in different areas. When you look at what's going on the internet, the media spend, despite the shift of eyeballs to the internet and to mobile, the media spend is still on traditional media. And so we think there's great opportunities there. When we look at mobile technology, I met with the Senior VP of Products for Verizon Wireless last week, and their goal or their expectation is within the next 5 years, their subscribers, they'll have 5 subscriptions per, or 5 devices per subscriber that they'll be taking revenue from. And so they're trying, that's a pretty lofty goal, but they're really trying to penetrate everywhere with mobile technology. Sorry, is there a question? Okay. And we're also seeing this incredible growth of data traffic, which is why you're seeing mobile providers around the world go from the all-you-can-eat plans to plans that are more measured. The explosion of cloud computing, even though it's a bit of a throwback to time sharing, is, for those of us who are old enough to remember, it is really driving an inflection point in enterprise innovation and really making the cost of computing for startups, for little companies, for big companies, change dramatically. And then as we look at the cost of sequencing a genome, is plummeting, and the amount of innovation that can come as that starts to approach consumer pricing. And we've seen a number of startups that are trying to create essentially the $1,000 genome or less. I am trying to go through this, and it wouldn't be a presentation about innovation if I didn't at least have one slide on renewable energy and energy technology. It has been a place where a lot of money has already been spent and lost, largely focused on, say, the first wave, which is around power generation. But we're seeing some incredible innovation around LED technology. We're seeing it around the components that go into lowering the effective cost of solar and wind. And this is where great universities are leading the way. So I just have a couple of slides left before we can get to the main event. Charles, what does this new model mean for entrepreneurs? I think that, quite frankly, there has to be a focus on capital efficiency. And if I think back to the kinds of projects that we backed around the year 2000, and some of the things that we did, quite frankly, up here in Ottawa as well as in the Boston area, they were truly, they were reaching for the stars, but the capital models just didn't work. So it's easy in hindsight to look at it, but a company that needed to raise $100 million in order to get to market may not have ever truly been viable. It certainly is not viable now because the cash is just not there. And what we are seeing is a focus on new models. And so the garage model of bootstrapping and perhaps raising money from friends and family, not going out to raise institutional capital until the companies reach profitability, is a throwback to the origins of the venture capital business in the 1970s when venture capital firms did not invest in startups. We're also seeing a huge rush around seed investments. And these are the $200,000 or $300,000 investments, maybe up to $1 million in total, to get companies past some sort of major inflection point. And when you look at the Web 2.0 companies, as well as companies that are doing more core science, we're starting to see some really emerging winners that have taken that approach. And I think from a venture capital standpoint, we've had to relax our requirements about what it means to invest in little companies because the hit rate for those kinds of companies is going to be quite low, lower than our expectations have been for other companies. But it's important that we provide that kind of capital in order to stir the pot for innovation. And as I mentioned, I think these supersized first rounds are really going to be hard to come by. I think there's got to be a concentration on new areas with huge potential in the size of market. I mentioned a few of those in previous slides, but fundamentally, I think that the entire ecosystem, we need to look for things that can be big changes. The president mentioned that we can change the world. It sounds like I'm trying to be a cheerleader, and I guess I am. The idea of incremental advances is not something where we can afford to put our money. And quite frankly, as entrepreneurs, I'd ask you, is it really a place where you can afford to spend your time? Because the potential for outcome, the potential for making a contribution is just a lot lower, and it's just tough to differentiate and build a business. And these financing models are morphing. There's been a lot of talk, particularly in the US and in Silicon Valley, around super angels, which are really successful entrepreneurs who are taking their own money and turning it around and investing in startups. We've seen a bit of that in Boston. We've seen a lot of it in New York City, where we're spending a lot of time. I don't know that has made its way north as much. It's something that I would encourage successful alumni of this university, as I look at Charles, to be focusing on, because there is such great innovation up here. And then, this notion of another new model, what I call the full-funded staged approach. I invest a lot in semiconductor companies, and Along with 5 other firms, I recently invested in a company that has the modest goal of taking down Intel in the data center by taking the ARM processor, making a multi-core version for servers for high-scale data centers. Now, this is a company that will require, which really is a contradiction of my first point, will require a boatload of money in order to get to market. And so to combat that, what we did was we took 6 firms and we committed $50 million of capital over a series of rounds where, as the company reaches milestones, it gets funded. They don't have to go out and make any other additional venture capital pitches. It allows them to keep their head down. And it also, from an investor standpoint, it allows us to mitigate the risk to see as they develop. This is something that it's really a new approach, and I credit one of my co-investors with coming up with it. I'm amazed that we were able to pull it off, but I think that this is indicative of us trying to innovate our models. What it doesn't mean that venture capital investors won't invest in early stage ideas. It also doesn't mean that we're not going to invest in Canada. Quite frankly, as a firm, we have 3 investments out of the 50 that we've done in Canada, the highest concentration of non-U.S. investments for us. We continue to look at companies north of the border, and we like to. Quite frankly, there's less competition for us up here. There's great innovation and a great spirit. So another reason why I'm happy to be back in Ottawa. It also doesn't mean that we're just looking for these epic returns. It would be fabulous to have a YouTube-like return in our portfolio or a Google. That's not how great funds are built. And my crystal ball at the time of making an investment is terrible. And so the idea of trying to predict that something could be 100x return is just lunacy. Instead, the way that we look at it is we want to make sure that with a modest amount of capital, a company can get past kind of the proof point, and that we believe at the inception of our investment that there's a chance to build something big, and that the path doesn't look like it requires suspension of many of the laws of physics. It doesn't mean that we're replacing angel investors. We're actively making seed investments, as I mentioned. And I actually think that I'll probably stop there, unless you want to keep going? Okay, I want to make sure that I'm adhering to time. So I had some backup slides. So some semi-random thoughts about my industry and then how it affects. It turns out that through studies, venture capital performance is highly persistent. The good continue to do well, but so do the poor. The good continue to do well. It turns out poor performers are persistent as well. And the study, which was quite remarkable, showed that a first-time entrepreneur has more of a chance of success than a repeat entrepreneur who failed their last time out, which is kind of sad in a way because it indicates that we're not learning from our mistakes as much as we would hope. But it also says that as you're thinking about putting companies together, the idea of mating the lessons from the past with innovation and with folks who really don't know that they shouldn't be able to accomplish something that they're setting out to do is important. For us, deal sourcing is a key factor. And as I mentioned, success is more likely for first-timers than it is for those that failed the last time, which is why I'd say that half of my time or more is spent talking to entrepreneurs with new ideas. And I always liken myself to a bit of a tree farmer in that we're planting seeds, and by talking with entrepreneurs, my 13-year-old is convinced that all I do for a living is meat. And by talking to entrepreneurs today, we might find an investment in a few months or a few years. And it takes a while in times for those seeds to grow. But trying to find that mixture of innovation and combining it with serial entrepreneurs is important. Let me just try and see if there's anything else here. So a little bit, I guess maybe my last point, on raising money from venture capital firms. What we're looking for are really big, unique ideas. We want a relevant team, and I put an asterisk by it, because the team doesn't have to have been there and done it before. It doesn't have to have kind of the repeat offenders who've been successful 15 times in the past. The data shows that we also want to look for those innovators. We're looking for customer feedback. So if you're coming to pitch a venture capitalist or an investor, one of the best things you can do, even if the idea is still on a napkin, is to have talked to some of your potential customers to get their feedback and to bring that in. it's so obvious, yet it's amazing how few times when we see entrepreneurs, they've actually taken the time to do it. As engineers, we spend a lot of time looking down instead of looking out. I think we're looking, as I mentioned before, for minimal cash to prove the model. And the way that we think about that is that on the first, say, $7.5 to $10 million of capital that goes into a company, probably less so for a web-type project, if you can't prove that there's a business, it probably means there isn't a business. And so the idea of getting to that answer as quickly as possible on as little dollars as possible as part of your plan, we think is important. The ability to articulate what you're doing quickly, the old saw about the elevator pitch, being able to explain what you're doing in a few sentences on an elevator ride, I think really matters. And if in 10 PowerPoint slides or less, you can't communicate what you're doing, why you're addressing either a problem that exists or one that will exist, and why your solution is the best thing to do, then you probably haven't given enough strategic thought yet, and you're probably not right to start the company at that point. You should spend more time trying to hone it. And what we're looking for is really good people who want an active partner. And this is meant to be less of an advertisement for Flybridge, but I think any early stage venture capital firm you're going to want to be in business with has got to provide you with more than just money. And so we want to look for partners, and we want those who want more than just the dollars. What we don't want to see is a business plan tome. We screen as a firm 8,000 to 10,000 new business plans a year. We do not have time, and I have great admiration for those of you who write business plans that are this thick. And if it helps you figure out the strategy, the technology, the focus, that's terrific. I want to see, to begin with, that 10 PowerPoint slide that articulates at a high level what you're doing, and then get deeper into it if we make it past that first session. But if you just think about, if every venture capital firm has such little time to screen something, it becomes important to be able to articulate succinctly what you're doing. We're not looking for advisory boards as substitutes for teams. We see it a lot with early stage startups. If you've got a hole in your team, acknowledge it. It's great if you can find an expert from academia or from business who can help you out. But let's have a conversation about the person that you need on the team to help drive it, because an advisory board member, if they're not working full-time for you, is not going to create the value that you need. I'm guilty of it in this thing. We don't want to see PowerPoint reveals. I mean, to get through that slide deck and to see, wait for it with all the pushes is really just a waste of time. And don't feel that you need to be buzzword compliant when you pitch to investors and talk about, so you can think about all the buzzwords that are out there in venture speak. We just want to hear what you're thinking about, why it's important, why you're excited, and why we should be excited. So to recap, I do believe the next 10 years is going to be a golden age for technology. Don't let the bumps spook you, because there are bound to be more. I think that the U.S. is by no means out of its recession, and we're going to see the results of that over the coming months. But the globalization and the digitization, the expansion, is really bringing advancements faster than we've ever seen it before. And to understand these changes in the landscape will provide you with a chance to be innovative. So be original. Thanks very much.
Thanks, David. That was a terrific presentation, and David's presentation and my presentation really dovetail well together, because he gives a macro view, and I'll provide more of a micro view to tech startups. And you might call this 10 years and 10 lessons. It might be 10 years and 10 mistakes I learned from. And what is forming my view in this presentation is some of my experiences in my own startup and in 10 years of venture capital and being involved directly in other startups. One example is the company I had co-founded in the late 90s. We ended up raising 1.5 rounds of capital, and we sold the company for about almost $450 million, almost 20x times the investment. But more importantly, when we were acquired, The company that acquired us went on to, we utilized their channel to sell product, and in our first full year of shipping, we ended up shipping a $250 million run rate in product. And the value of the company that acquired us went up 20x from there. So if you held your stock of the company I had co-founded, you would have gone up 400x. And part of it definitely was due to the tech bubble in the late 90s, but part of it, I think, is due to, I hope, the revenue that we drove at the acquiring company. Ultimately, what I'm really gratified about in that company, or really proud about, is that the product's still shipping today, 12 years later, with the same chips that we had designed maybe 14, 15 years earlier. So it's an incredible story of when you get a product right for the market and what can happen to a business. A second example is I worked with a friend of mine for almost 5 months. He had a rough concept of a technology idea. And I worked with him for 5 months to create a business. And he wanted me to join as the CEO of the company, and I wasn't ready to leave venture at that time. And we raised a small amount of money. From Greylock, we raised $3.5 million, and I was on the board representing Greylock. And as the company progressed, the technology was very interesting, but it was really a technology looking for a business. And we did the right thing. We sold it at the peak of hope. And, startups often have this peak of hope, where hope is better than reality. And we sold the company in 18 months to Microsoft for $120 million. And there's a lot of times when people think, this is going really well, let's not sell the company. That was the perfect time to sell that company. And this is an area called desktop virtualization, and there are a number of companies playing in this space. And they didn't sell, and they're still suffering through, trying to build a business. And the last one I'd like to mention is a company that David knows a little bit about because he was kind of involved in this. It was a company where engineering was in Israel, and headquarters, which was 4 people, was in Silicon Valley. And the company was a disaster. The CEO had really driven it into the ground, spent a lot of capital going nowhere. And Greylock and the co-investor just wanted to shut the company down. I said, well, there's something here. David helped me do the analysis. I said, there's something here. Why don't you give me some seed capital, some bridge money, and let me see what I can do with the company. So I fired the CEO and worked on the product. I traveled to Israel over 12 months, 14 times, and got the product out, repositioned the company, got the product out, got our first customer, which was HP, raised an oversubscribed round as an acting CEO, and in 2 months later, Broadcom came knocking, and we sold the company. So we were able to get our money back, which is a loser for most venture capital investments, but it was much better than losing all our capital. So those are some of the lessons, anecdotes, I guess, that formed some of these thoughts. And I only have 3 slides, one of them being the title slide. So I don't have a Harvard MBA. So this first point seems almost self-evident. Venture capital invests in business first, technology last. It's, obviously technology for technology startups is very important, in some case critical, but it's really just a lever to the business. And it's amazing to me how many startups come through the door, almost half of them come through the door, really talking about technology, not thinking about the whole business. And the flip side, too, is Web 2.0 companies who come in and present what they're doing, and they say, well, my business is advertising. Well, what do you mean by advertising? How are you going to attract advertisers? So what investors are looking for is not only the technology, but the product, the business, the market. How do you get to cash flow break even? How much revenue do you need? How much capital do you need to get through those milestones? Before you get to this, you could even do a seed. A lot of geeky VCs like myself want to invest in technology and will seed the company, but ultimately you have to get to this hurdle of doing a real substantive round. And when this comes all together well, it can go remarkably well. I'm involved in the startup full time now. I spend less than 10% of my time on venture and almost all my time on this startup. And we were able to, I put my heads together with the founder, and we create a new business plan for the company. And in a process that might take 3 months to raise capital, we raised capital in 3 weeks. We were oversubscribed. We ended up raising 50% more capital than we were asking for at a much higher valuation. We actually turned away capital on the day we told the other VCs that we signed a term sheet. Some of them came back and said, well, we'll give you 50% uplift from where you are now and more capital just to get in the deal. You don't have to change the deal terms that you're in. So when you get these things right, from the go-to-market, the customers, the market, the unfair advantage, when you get those things right, it's a really good start for the company. VC financing is not for all businesses. I have a number of friends that have 15, 20, $30 million revenue businesses, and they pay themselves a healthy salary, well over $1 million. And the conversation always goes like, Charles, I wanted to ask you about venture. And I think right away I know where this conversation is going, because not all businesses are appropriate for venture capital. They may be great businesses and they can grow over time and even be public companies over a long period of time, but those types of businesses are not for venture capital. Venture capital is looking for companies that can go public in 5 or 6 years on the outside. And you don't know if you're going to go public, but you have to be able to have the assumption or the thesis that you can go public. And so it's really, really critical that the type of business that you go speak to a venture capitalist about is one with very, very high growth rate, a lot of leverage, and can conceivably go public. Doesn't mean it's not a bad business if venture financing isn't the right round. So this is another self-evident comment. Founders make all the difference, for good or for bad. What VCs are looking for first and foremost, first of all, they're trying to predict the future, especially in early stage companies. They're trying to figure out whether this company will make it over the next 3 or 4 years and get to that IPO. And it's all driven by a set of PowerPoint slides and the 1 or 2 or 3 founders of the company. And founders make all the difference, because what we're looking for, or what investors are looking for, first and foremost, is a thought leadership. The individuals who are driving this company must be thought leaders in that space, because they are competing at a world-class level. And unless you have the best founders possible, it's very difficult to build a business as a result of that. And I've seen the pluses of this and definitely the downside of not having the right founding team. Raise capital for your idea, not the investors. This is kind of a subtle point. Often you'll get an entrepreneur come in with a really interesting idea, and I've been guilty of this. And VCs are, they see 1,000 business plans a year. They see a lot of opportunities, and they're very good at coming up with ideas. And they say, well, instead of going after market A, why don't you go after market B? Because market B is really, really interesting. And so as an entrepreneur, you have 3 choices. Either you convince them that market A is the right thing to do, and you get your financing. Or B, you go away and say, or 2, you go away and say, I'm going to become a thought leader in market B. I'm going to try to understand everything I can, and then I'll change my plan to do going after market B. Either of those 2 things are fine. The worst thing you could do is just say, okay, I'll go after market B, and why don't you fund me? Because the last thing that happens is the entrepreneur is responsible for executing on that plan. And if they're not thinking ahead, if they're not 2 steps ahead of what that market B means, they're just bound for failure. And the venture capitalist isn't going to be driving that business. You are going to be driving that business. And they don't have to execute. They just come up with the ideas. 5, venture capital is a selling process, just like selling anything. In this case, you're selling part of your company. You have to think about it as a selling process. You have to think about it as, who's their customer, what your product, your business is, how they want to hear it, create a sense of urgency. This is a very difficult thing to do. Venture firms can take all the time in the world to analyze a deal, and it actually works in their favor, because as more time goes by, more cards get turned over, and you can make a less supposedly risky decision. But that works against the entrepreneur, of course, because the entrepreneur wants to get funded now and get going. So it's really, really critical that somehow you create a sense of urgency. usually the only way of doing that is having enough venture capitalists that you talk to that you move one ahead of the other and keep the process going. To that point, the number of VC presentations that you do does not increase the likelihood of funding. It's not a numbers game. I recall an entrepreneur I know, he was listing all the venture firms he was going to go talk to, and he had an Excel spreadsheet, the ones he's talked to, the ones he's going to talk to, and the ones that he'd like to talk to, and the list was something around this long. He's tracking everything. And you know, I think the rule of thumb is if you can't keep it in your head, you're talking to way too many VCs. And it isn't a numbers game. In fact, there's huge diminishing returns when you talk to a lot of VCs. And why is that? It's because when I see a company, first of all VCs are more or less friends. They compete on deals, but it's a lot of co-opetition. Because one day you may be competing, but the next day you're on the same board of a different company. So we see a lot of deals. I might see deals that call up David. David, did you see Susan's company? I say, yeah. And I say, what did you think about it? Oh, it was interesting. And I call up my other friend, Mike, did you see Susan's company? Yeah, it was interesting. After a while, you start meeting 10 of your friends who've all seen the company but haven't funded it. And so even if you might have liked the company, you start thinking, what's wrong with this deal? Nobody's done it yet. And it's better for you to call your friends and nobody's seen it. And so you think you have something special here. Because the VCs do have a problem of wanting to fund that shiny penny. They don't want that leftover dollar bill. They want to do that. You find that shiny penny that they can build into something. So when you talk to 50 VCs, that's the worst thing you could do. In that company I mentioned that I'm involved with now, we talked to 6 VCs, and we were oversubscribed. We created a sense of urgency and a sense of rareness that somebody had to act, and they acted quickly. This is a really subtle point as well. A lot of people, even experienced entrepreneurs, don't quite get. Your current financing is really shaped by the next financing. And what does that mean? What you're trying to do is raise a pile of capital to take you to a significant milestone. And that significant milestone better be significant enough where if you have to raise more capital at that milestone, it better be significant enough that it interests other investors to invest in the deal. And even some VCs don't get this very well. It's really critical that if you're investing today in that round, say a Series A, that when you get to the Series B, there's enough value or way more value that will attract other investors. One of the trickiest investments to do as a venture capitalist is the Series B. Assuming that A is to help build the business, B is help to grow the business, and C is kind of the mezzanine round to going public. Well, in the Series B, you're trying to figure out, it's that really thin line between hope and reality, and how much revenue do you have, or how much more do you have to go? And if you don't have that in mind, if you raise the wrong amount of money, or if you don't even think about that, and you can't articulate what the financing plan for the company is, it'll be extremely difficult to get your Series A closed. Almost, I would say it's impossible to get it done without really thinking ahead of what your Series B is going to look like, or your Series C for that matter. A complex term sheet is a yellow flag. I don't know if I'm going to go over terms that are not familiar with you all. How many of you have raised venture capital before? Okay, so it's a small group. Do you know what a Series A and a Series B, the rest of okay, great. And valuations, right? So in a term sheet, it's what are the terms by which an investor is buying part of your company. And what I'm referring to here is not complexity of later stage rounds where there may be some complex financial transaction that includes debt and so forth. I'm thinking of an early stage company. And I've seen this 10 years ago with Canadian venture firms, and they put a lot of complexity in their term sheet with accruing dividends and kind of bank type covenants. But your traditional venture firm, particularly in Silicon Valley, if you have a complex term sheet, the old adage is you can't fix a bad deal, you can't make a bad deal good with terms. And there's some venture firms that will try to do that. And you have to ask yourself as an entrepreneur, why is this happening? One, is it a right venture firm partner for me? Two, what am I doing wrong in the deal that is causing to have all this complexity? Because the complexity is not bad just because it's complex. It's bad because there may be really mitigating impacts downstream for the company, especially if you go through a difficult time and you have to raise capital at a down round. A complex term sheet can make it very, very difficult for the entrepreneur to even realize a gain in the long run. My advice here is do whatever you can to either remove complexity or even take a lower valuation. Ultimately, it comes down to valuation. A lower valuation in order to introduce simplicity. Number 9, VC financing is no stamp of approval, no guarantee of anything, not even a job. I meet a lot of entrepreneurs who say, I just got funded by so-and-so, or I'm a so-and-so firm company, as if being associated with that brand name venture firm will make a difference. And it does, on the margin, particularly when you're raising capital, because a good venture firm will attract other venture firms to co-invest in the deal. At the end of the day, though, it's really up to you as the entrepreneur to make something out of that business. And, the venture firm does 30, 40 deals a year. You're just one out of 30 or 40 deals, and they have hedged their bets across lots of different companies. You have one chance to get it right. And as soon as you don't get it right, you'll be out of a job, you'll be off their website, and they'll not be thinking about you. My last point is, again, an obvious point, and I really sincerely mean this, particularly in Ottawa, because I see a lot of company entrepreneurs here who have a good idea, but have a lot of add-on on the team. People who were in banking or something that know something about finance, and all of a sudden they're the chief operating officer of a 2-person company. It's really important to build the best team, ideally that you can, ideally in the world. At the end of the day, you are competing on a world stage, whether it's a Web 2.0 company or a product company, because there's probably the exact same company doing what you're doing in Israel or in China or in Silicon Valley. You have to have the best team in the world, assuming that you want to build a great, long-lasting company. And with that, you have to execute quickly. There is no bigger burn rate to a company than missing a date. Because when you're missing a date at your first revenue, that's probably when you have the peak amount of people, peak amount of expenses before revenue. And if you miss that by a month, 2 months, a quarter, you can see how quickly you can drain the coffers. So that's it for my 10 mistakes that I learned from. And I'd ask David to come join me here and we can answer some questions.
Felix is going to be watching with some gifts.
Oh, wow. Thanks a lot, Bill.